The 4% rule seems simple enough, but there are all kinds of nuances and details, and it's important to understand them so when you apply it to your portfolio, you can create the most comfortable retirement possible. In today's video, I'm going to walk you through the foundations of the 4% rule, as well as how you can apply this in practice so you can get the most out of your retirement. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. So here's a common question people have when it comes to the 4% rule. They'll use an example. They say, hey James, I had $2 million in my portfolio a year and a half ago, but with the market downturn and different factors, now I have $1.5 million. If I'm using the 4% rule, do I apply it on the previous value at its all-time high? Do I apply it to today's value? Where do I actually start with this? So it seems like a simple concept in theory, you can start to quickly tell has some real-world implications that aren't explicitly addressed. So what I want to do today is help you understand what were the details of this research regarding the 4% rule and how can you most effectively apply that to your situation so you can make sure you have the most secure retirement possible. So let's start with the general overview. The 4% rule didn't just come out of thin air. It's based on a lot of serious research by a guy named Bill Bengen. And what Bill Bengen, who is a financial advisor, wanted to know is when he's advising his clients, how much should he tell them they can take out of their portfolio? And not just how much could they take out of their portfolio if there's good conditions in the market, but what if they retire and have poor conditions or even horrible conditions? So what he did is he backtested several years and decades to say, based upon when you retire, what's the greatest amount you could take out of your portfolio to the extent that whether you retire in a great time or a bad time, you were going to be okay for at least 30 years. Now, when he did that, he said 4% is kind of the magic number. Or whether you retire into a great bull market with the market rising every year, or you retire into a horrible bear market with the market falling each year, that was the highest number he initially looked at to say you would be okay for 30 years in each of those scenarios. Assuming you took 4% of the initial portfolio value and then increase that dollar amount with inflation over time. Now here's some things that are important to note about this research so we can start to see where research ends and theory ends and application begins. Number one, he assumed that you would take out the entirety of that 4% on January 1st of each year. So when he backtested this, he wanted to say, well, what would this look like if I took 4% out starting in 1980 or 1972 or 1960 and all these different years? Well, he looked at taking that full 4% out on the first day of every year and doing the same year after year after year for 30 plus years. Now in reality, most people aren't doing that. Most people are taking money on a monthly basis or on a quarterly basis or even maybe a bi-weekly basis from their portfolio. So as you're implementing this, you have to understand how can we apply what the research says with how we're actually applying this in our portfolio. So there's some details there to make sure you're aware of as you're applying this to your situation. The second thing to note is 4% wasn't the only withdrawal rate that Bill Bengen looked at. He looked at 5%, he looked at 6%. He looked at this to test it to say which withdrawal rate was sustainable regardless of what type of market environment you retired into. Now here's the thing, there's plenty of years where a 6% withdrawal rate would have worked just fine. Meaning you could have taken 6% per year of your portfolio and been fine for 30 years. However, there was other instances where if you were taking 6% per year, your portfolio only lasted for 15 to 20 years. So what he had to do was he had to say, we have no idea what's coming at us in the next 30 years if we're going to retire. So what's the highest we can take without running the risk of not having this money last for 30 years? So the implications of that are if you're using 4%, that's a great place to start, but you also might be selling yourself short. There were many instances when you could have taken 5% or 6%, even 7% or more in some instances. So when you're applying this, understand that's a good place to start and look at this 4% rule. However, if you're not dynamically looking at this year by year to say, are we in a good market environment? Are we in a bad market environment? Are we ahead of schedule? Are we behind schedule? If you're not applying a more dynamic framework, you might be selling yourself short in terms of taking less income from your portfolio than it otherwise could have supported. The third thing to note about Bill Bengen's research is the portfolio he backtested was based upon 50% large US stocks and 50% intermediate term US treasuries, so 5 to 10 year government bonds. Now the reality is most people's portfolios don't look exactly like that. And even Bill Bengen, when he went back in and added small company investments to the hypothetical portfolio, what that did is it increased the withdrawal rate from 4% to 4.5% as a sustainable rate that you could take out. So that's what the test showed. What are the practical implications for us as investors? Well, the practical implications are, again, 4% might be a great place to start, but if you're better diversified, because maybe you have small companies or international companies or emerging markets or whatever it might be, there's the chance that your portfolio could support an even higher withdrawal rate and still be sustainable for a 30+ year retirement. The next thing to note is this initial research, it didn't have what other researchers would come to call guardrails around it. What do I mean by that? Well, Bill Bangan's research looked at this. It said, what's the amount that we start at when it comes to withdrawing money out of our portfolio so that we can simply increase it with inflation for 30 years and be okay? Well, that's great to know that, but the reality is if you're doing some proactive planning, you want to know, well, how are we doing 3 years in, 5 years in, 10 years in, 15 years in? What if the market's doing tremendously well? I want to know I can get some raises. I want to know I can spend more than that 4% simply adjusted for inflation. Or on the flip side, what if I retire and the market drops 3 years, 4 years in a row? Well, should I build in some safety buckets to say, should I cut spending even just temporarily to create more income in the future by not taking too much out of my portfolio in those initial years? The example I like to use is if you retired in 1975 and if you had a 30-year retirement, a portfolio of just 50% stocks and 50% bonds, it could have supported a withdrawal rate of 7.5% per year, and you would have been fine for those 30 years. So if you're just starting with one withdrawal rate and never doing anything to manage that in a more dynamic way throughout your retirement, you might be selling yourself short. And that might not seem like a big deal, okay, 4% versus 7.5%, but think of it this way. If you retire with $1 million and you just apply the 4% rule, you could take $40,000 per year out of your portfolio. Well, the reality is if you retired in 1975, a sustainable withdrawal rate was closer to 7.5% per year. So that's $75,000 you could have taken from your portfolio. If you're living on 40 instead of 75, that's $35,000 fewer dollars that you would have had to travel, to enjoy time with friends and family, to do activities you care about. It's a real significant lifestyle shift simply because you didn't apply a more dynamic framework when it comes to your portfolio withdrawals throughout retirement. So make sure, again, you know where you're starting from, but are there things you can do to increase that if there's good environments in the market that would justify doing so? So why is it important to know these things? Well, for one, people just take these withdrawal rates and these withdrawal rules for granted. So they say, oh, 4%, that's what I can take from my portfolio. Doesn't matter if I'm all cash or if I'm all stock or if I'm diversified or in a single stock. That couldn't be further from the truth. This 4% rule didn't just come out of thin air. It was based upon research with the diversified portfolio of 50% large cap stocks and 50% government bonds. So make sure that you have a portfolio that could support this. And then the second takeaway is, can you do better than the 4% rule? There's never any guarantee of anything, but follow-up research by other researchers showed that yes, if you diversify your portfolio further, if you apply some rules and decision frameworks to the way you take money out of your portfolio. In other words, when do you give yourself a raise? When do you temporarily cut back on spending? When should you freeze and have no inflation adjustment? If you apply these types of decisions, then it only makes sense that you could start by taking more out of your portfolio because you're going to dynamically adapt to different market environments going forward. So don't sell yourself short just by looking at a simple starting point. And as helpful as a 4% rule can be to give you a general sense of what can your portfolio do for you, we need to make sure that we're adding on to that, not just to see what can my portfolio do for me to be okay, but how can I get the most out of this and ultimately get the most out of life with my money. I want to give just one more example to illustrate this and really bring this point home. Let's assume you have two people. One person retires on October 9th, 2007 with $1 million in their portfolio. Person number two retires on March 6th of 2009 with $700,000 in their portfolio. Well, if you just apply the simple 4% rule as it stands, that first person would be able to spend $40,000 per year for the rest of their life, inflation adjusted, and the second person would be able to spend only $28,000 per year for the rest of their life, inflation adjusted. So a pretty significant decrease, 30% less than person number one. Now, why did I bring up such specific dates? Well, that first date was the date at which the S&P 500 or the US stock market peaked before the market meltdown of 2007-2008. The second date, March 6th, that was the day at which the market bottomed. And if you were in a 50% stock and 50% government bond portfolio going into the 2008 market meltdown, your portfolio would have dropped by about 30%. So $1 million going into it would have turned to about $700,000 by the end of it. So as we look at those two individuals retiring about 18 months apart, the reality is they're the same individual with the same portfolio. The only difference is the timing of their retirement. So why is it the individual one who retired earlier should be able to spend 30% more simply because the timing of when they retired? The reality, because it's the same person with the same portfolio, they should be able to spend the same exact amount. In fact, maybe the person that retired later should be able to spend even more because they went 18 more months without drawing down their portfolio. This simply shows some of the inherent downsides of just applying a 4% rule to your portfolio and then sticking with it forever. If instead you applied those rules and the decision frameworks of when do I give myself a raise, or in the midst of this market falling, can I freeze any inflation adjustments? Can I temporarily cut spending, not based on a feeling, but based upon actual rules that you can apply to your portfolio? What that does for you is it allows you to maximize spending from your portfolio while also ensuring you're not doing so to your future detriment. So as we're walking through this, if you're saying, James, this makes sense. I understand that the 4% rule can be a good place to start, but maybe it doesn't fully address all the things to maximize the income from my portfolio. Well, take a look at this video here, where I actually walk you through those rules and what things can you do to potentially spend more than just 4% from your portfolio in retirement. Once again, I'm James Knoll, founder of Root Financial. And if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.